Nvidia, Tesla, Google, Meta platforms. Are they a buy today? Let's find out in this video. So in part 1 of this two-part series, we have actually set out the context of how the Magnificent 7 stocks carried the entire US stock market in 2023. So we have mainly covered Apple, Amazon and Microsoft. But some of you have complained that they are too boring. So we are back with the more exciting ones. Let's go. The candidate with the weakest performance on a year-to-date basis is, drumroll please, Alphabet, at right around 50% in the past 9 months. Yup, you heard it right, 50% year-to-date appreciation, and it's the weakest performer out of this lot. What a time to be alive in this market. Anyhow, Google did not start the year out strong. Although it feels like eons ago, ChatGPT was only introduced just November of last year, and it took the world by a storm, Google included. So upon the few iterations, Microsoft, who's the largest investor of OpenAI, which created ChatGPT, has decided to integrate their large language model into their own native browser Bing, claiming it to be even more powerful than ChatGPT. And in Satya Nadella's word, make Google dance. So Google's response to that? Release their own version of large language model, Bard. But long story short, the initial release was not as exciting as what many investors actually hoped for, and to add on, there were notable errors caught during the presentation itself, causing investors to essentially sell down the stock because many were actually disappointed with the results of the high R&D spending Alphabet has actually spent over the years to only push out a half-baked product. To add, investors from all walks of life were confident that we are going to experience a recession sometime soon. Google, being in the advertising industry, was primed for a major slowdown in growth as advertising is highly cyclical, which models after the ebb and flow of the economy. So Google reported a revenue growth of less than 1% year-on-year for Q4 of 2022 earlier this year, triggering another round of sell-off as investors started turning pessimistic around the prospects of the business itself. I would also turn pessimistic if you forget to smash the cute little like button. So remember to make my day by clicking on it. Weak revenue growth, coupled with intense rivalry coming from a formidable competitor attempting to grab Google's dominant position in search, was essentially a double whammy. So in hindsight, we've come to appreciate that it might still be a little too early for users to completely adapt their workflow to one that is reliant on AI search results without verifying the veracity of the data themselves. It was also reported that ChatGPT's traffic actually slipped again for the 3rd month in a row, suggesting that Google might be in a much better position to retain their market share, contrary to what many investors initially thought of. Google is currently trading at a 24 times forward price to earnings, with a free cash flow yield of around 4.1%. So I don't think it's necessarily expensive, but it's not dirt cheap either. So we do still think that given the strength of Google's fundamentals today, it is still trading at a slight discount to its intrinsic value. And our calculations have it worked out to be right around $153 to $170 range. So moving on to our next contender, who's another juggernaut in the advertising space, Meta platforms, formerly known as Facebook. So Meta has outdone Alphabet by a factor of nearly 3 times, as they've experienced an appreciation of nearly 150%. This spectacular performance came on the heels of a 75% decline back in 2022 from its peak due to a myriad of concerns, from stagnating growth rates to destruction in margins to frivolous spending to Mark Zuckerberg's own obsession with augmented reality, and of course, a sheer disregard for accruing shareholders' long-term value in any way thinkable. At least, that was what most bear arguments were arguing for in the better part of last year. So in 2023, the past few quarterly earnings have shown that there is a certain level of normalization in terms of both margins and also bottom line profits and cash flows. Further, they've squashed concerns in Meta being unable to acquire new users anymore, as they've continued to show growth on both active users and also ad impressions. Zuckerberg has also clarified in multiple calls that the majority of their investments are into the AI capabilities of the legacy business, including the family of apps. iterating and building on their existing ads architecture, rather than just simply blowing it all up in their AR/VR efforts. They've also come a long way in addressing concerns over the new Apple update, which has heavily restricted their tracking and targeting of advertisements. The icing on the cake was when Meta increased their share repurchase authorization by a factor of 40 billion, which worked out to be around 10% of their market capitalization when it was announced, boosting confidence once again to fellow Meta shareholders. So despite Meta platforms having a PE ratio of 36 times now, the consensus estimates has their forward PE to be right around 22 times, with a free cash flow yield of only 3%. So the trailing 12-month free cash flow yield might not be a very accurate representation, as they've experienced some sort of an identity crisis, if I can put it that way, back in Q3 of last year, causing their free cash flow to essentially evaporate. So an identity crisis so large that they had to change their company's name. Anyhow, Meta was also in that period of spending large amount of capital expenditure, causing a huge hit to their bottom line. So we are optimistic of Meta swinging back to being highly profitable and cash generative again. But investors must definitely be comfortable with Zuckerberg's money-losing pet project on the side, as they've committed that there will be an increasing cash burn set aside for the Reality Lab segment. For Meta's valuation today, even after this phenomenal run-up, I don't suppose that they're trading at an egregious valuation. So if I may speculate, the reason why both Google and Facebook trades at a relatively lower valuation compared to their big tech counterparts is because other big tech are now zeroing into the advertising industry, namely Apple, Microsoft, and even Amazon. So everyone wishes to have a bite at that pie. So given conservative estimates, Meta's intrinsic value for us actually sits at around $280 to $330, and we will want to wait for further pullbacks before adding to them anytime soon. Now, Nvidia. Arguably the only company that has truly benefited from this entire artificial intelligence craze that flowed through to their earnings and bottom line cash flows. Last quarter, they grew revenue by 101% and net income by 843%. These are not rookie numbers, by the way, especially for a company that is already established with a relatively high base. So when talking about Nvidia, you'll probably meet two different groups of investors. One group that completely writes them off as they cannot make sense of their current valuation using a rear view mirror when looking at their historical earnings. So they're currently trading at a PE of 108 times, price to sales of 34 times, and price to cash flow of 93 times. Their forward price ratios looks a little better as the street estimates Nvidia to continue delivering this sort of crazy growth. Meanwhile, the other group is extremely optimistic about the future of AI, GPUs, and the software-hardware integration of Nvidia, crowning it to be the iPhone moment for Nvidia. So truth be told, I'm somewhere in between. I don't think we should throw the baby out with the bathwater. Yes, I acknowledge that there were many companies that are jumping on this AI bandwagon recently, and the markets have traded their stock wildly. So for Nvidia specifically, I've watched and listened to many intelligent investors making their case for investing into Nvidia today. Reasons ranging from superior software-hardware integration to phenomenal foresight in their forays before their competitors in both crypto and AI. So although I'm a big believer in AI being the next frontier of innovation, I'm not so sure if investors are getting too ahead of themselves. Sure, Nvidia had blown expectations out of the water over the last 2 quarters, and will continue to do so in the following 2 quarters based on management's guidance. There is really not much visibility on how sustainable this growth will be. Some argue that growth in the short term is artificially boosted by these major Chinese players shoring up Nvidia's chip before the US ban, while others think that AI is the way to go and it will turn into a blanket tax for all tech companies moving forward. Who knows? Let's not forget that just a few quarters back, Nvidia saw a revenue growth of negative 20% year-on-year for their January 2023 earnings, as their sales took a bad hit, mostly attributable to the crypto winter. Yes, AI, data centers, they are the big talk in town now, but how long can it last? That is precisely why investing is so interesting yet challenging most of the time. So there are many analysts with price targets and valuation models around Nvidia today, but I think most of them will miss the mark. Therefore, whether Nvidia is a buy today really depends on how aggressive or conservative your assumptions are. Personally, I do find Nvidia's current valuation on the high side. I mean, the sky high side. So for people that are trading, I think Nvidia has got good momentum. So for investors that want to buy and hold, I think we can wait for a few more quarters to see how Nvidia continues to perform and deliver as the excitement dies down with time. I've separately penned down my thoughts about Nvidia's monster beat and guidance in 2 articles on the Piranha Profits blog, and I will leave the link to those in the description box down below. Last but not least, the fan favourite, Tesla. So like it or not, I'm going to offend one group of investors by having an opinion on this company. So I'll tread carefully. So Tesla has had phenomenal success and execution over the last few years. So the stock price aside, I think the company has executed superbly. To understand Tesla's valuation today, it really depends on how you see the future of this company. On the bearish side, if you view Tesla as solely a car company, today's valuations might look a little lofty as they sit at a price to sales of right around 10 times, while comparable companies like Toyota, Ford, and even GM have price to sales ratio of around 0.3 to even 1 times. So some might argue that hey, even if you were to look at Tesla as only a car company, you should compare it to a Ferrari because they too have a relatively high valuation. Personally, I disagree, as the nature of how they conduct their business is fundamentally different. Tesla is no longer even trying to compete in the premium segment of the car industry anymore. They just want to sell to anyone, anywhere. However, if you were to ask the bulls, they'll be showing you the other side of the story, where the car is just a Trojan horse for Tesla to sell you something even better, like full self-driving, to energy, to even robotics in the future. So just last week, an analyst report coming out from Morgan Stanley upgraded Tesla to an overweight, coupled with a price target of $400 per share due to their AI Mojo project. So Tesla is now an AI company too, huh? So this was extremely well received by the market because who doesn't want confirmation from Wall Street, right? Anyway, we do believe that Tesla is working on exciting projects and Elon Musk is someone that I probably don't want to bet against. But let's still be clear that many of the claims are still claims. I would highly encourage you to watch a live stream by Musk himself about the current state of Tesla's FSD capabilities. So here's the bottom line. Whether Tesla's valuations make sense today depends on how you look at their future, which is very, very uncertain. So some might point towards Musk's track record in disrupting the automobile industry and draw conclusions from there. Others, on the other hand, might be a tad bit more skeptical. Regardless of which side of the spectrum you sit on, let's give credit where it's due and celebrate what Elon Musk has done thus far that contributed greatly to the world's road to electrification. So if you would like to know our valuation figures for each company, do head over to our blog at piranhaprofits.com where we'll furnish the details. Link will be in the description below. So this is CK from Piranha Profits signing off. Till next time, keep winning.